Hello and welcome to a new video. In this lesson, I'm going to show you how to do a top-down analysis. So this is my personal approach on doing top-down analysis, meaning going from the weekly, the daily, the hourly chart, all the way to the 15-minute, 5-minute, and 3-minute to look for an entry. If you want your lower time frame strategy to work, whether it is the OTE, the 2022 model, I don't know, maybe the silver bullet. If you want your lower time frame strategy to work, then you need to learn the concepts that I'm going to share with you today. And I know a lot of traders are afraid when they hear the word higher time frame analysis, bias, weekly expansion, monthly expansion, but I promise you it's so easy. It's so easy to determine the higher time frame bias, and it's going to help you a lot in your lower time frame entries. And let me ask you this question. Have you ever seen a lower time frame market structure shift, a nice displacement leaving a fair value gap, an order block, a breaker, so the whole package, retracing, and you are on the kill zone, all right? And that's it up just failed miserably and left you feeling betrayed. And the reason for that is you didn't do the higher time frame analysis, and maybe you took a short on daily bullish fair value gap. So in this video, we're going to fix that. I'm going to take you from 0 to hero. So stick with me till the end, and don't forget to hit that like button and subscribe to my channel so you won't miss any upcoming videos. Now, the reason why we do higher time frame analysis is we want to determine the order flow of the market. Now, the order flow must be directional, right? Meaning the daily is bearish, all right? The hourly is bearish, and the lower time frames like the 15-minute and the 5-minute is also bearish. So all the time frames are aligned with each other and they are pointing to the sell side. It's just an example. We took a bearish example. Now, this lesson is going to be purely practical, so no theory. I'm going to walk you through examples and show you exactly my approach in doing a higher time frame analysis. Now, and before we start, I just want to give credit to the Market Maker X model. You can follow him on Twitter. He's a great trader, and by studying his charts, I was able to learn these things that I'm going to share today. He's a great trader, and I owe him on this one. Now, when I want to determine the bias on the daily or the weekly or even the hourly, I have two concepts in mind. And the two concepts are, first of all, internal range liquidity to external range liquidity, and external range liquidity to internal range liquidity. So this is the first concept. What do we mean by that? Meaning when price hits a fair value gap, which is internal range liquidity, the next target is external range liquidity, which is what? Swing high or swing low, all right? So after price, for example, take this internal range liquidity represented in a fair value gap, your next target should be external range liquidity, and this swings right here. So the price moves from internal to external and from external to internal, all right? So this is the first concept, and I have talked about it on my channel. You can go and check the video for more examples and more details. The next concept we're going to use is target. You want to target low resistance liquidity, and you want to leave behind you high resistance liquidity. Let's give you a quick example. I already talked about this concept in my channel previously. I'm going to leave the two videos in the description. So let's start with low resistance liquidity. It's something like this, right? So we have this clear trend, right? And we have this filled swings right here, right? So this filled swings represent low resistance liquidity, meaning we have a lot of liquidity below this swings right here, and that liquidity has never been touched. So the price will target them later on. So this is low resistance liquidity, and that is what you want to target. High resistance liquidity is something like this. For example, you have this. So you can see clearly the difference. So you can see that price is taking liquidity from these swings and immediately reject from it, attacking this external range liquidity. retracing, immediately take liquidity and immediately rejecting. So the logic is we have already take liquidity from here, then we don't have to go to this swing right here because the liquidity has already been purged. So this is what you want to leave behind when you take a long position, for example, here. So this is the second concept. By merging two concepts together, we can determine the bias of the market. Now let's start with the weekly chart. And this is New Zealand dollar against the US dollar. I'm going to give you many examples in this video so you can learn this with ease and you can apply them in your chart also. Now let's start with this. What do we have? We have a clear expansion to the upside, right? We are attacking this liquidity, external liquidity. So you want to draw it maybe like this. So we attacked this external liquidity, and also we have touched this internal range liquidity from here. So on the buy side, we have taken external liquidity and internal range liquidity. You want to target now internal range liquidity on the sell side of the curve. So on the weekly chart, we have determined that we want to go lower. So you can do something like this. You write on your screen, the weekly is bearish. Now, after determining that the weekly is bearish, we're not going to go to the 1 hour or the 15-minute chart and we look for entries. No, we don't do that. We go to the next chart, which is the daily chart. Now, the daily chart, we can clearly see that we take this external liquidity and hitting this fair value gap, right? And what do we have here? We have this internal range liquidity. So remember the concept. We want to go from external to internal range liquidity. Now the daily is also bearish, right? So you want to write that here. The next thing is you go to the 1 hour chart or the 4 hour chart. In our case, the 4 hour is pretty much the same as the daily. So we go to the 1 hour and we look for a change on the delivery, meaning going from a buy model right here to a sell model, all right? Market maker buy model, and you want to look for a market maker sell model, a reversal. We wait for a change on the market structure. And what do we have here? Now forget about the wick. The wicks do the damage. The bodies tell the story. So we have this market structure shift right here, right? So we have this market structure shift, and you can clearly see that the hourly is turning bearish, right? Now let's write this here. So the 1 hour is also bearish, and this is how you determine the order flow. Using this method, you can take high probability setups. Now on the hourly, you want to mark your PD arrays. So the PD arrays, we have this order block. Excuse me. We have this breaker right here. Let me remove this fair value gap, right? We have this breaker, all right? We have also this consecutive up close candles. This is a high probability order block. So this order block formed on a key level, take liquidity and left a fair value gap, right? So the characteristic of high probability order block. So we have this order block right here. And now you want to wait for price to retrace to 50% to premium. Or you can look for shorts when price hits this breaker. So this is the closest PD array. Now after determining the hourly is bearish, now you can go to the lower time frames and you can look for entries. So for example, you go to the 15-minute, all right? And we wait. We didn't retrace with that breaker, so we wait. Don't do anything here. Now you can see that we have this market structure shift right here. We have broken this swing right here is an intermediate term low because it balanced this fair value gap right here. So this is an important swing. We have violated this swing and we have this fair value gap right here. And we have this order block. So this up close candles are all order blocks. So this close candles, this up close candles, represent a high probability order block. We have already taken liquidity. And now let's talk about the second concept, which is low resistance and high resistance liquidity. We want to target what? Low resistance liquidity, which means filled swings. If you go to the hourly, you can see that we have many filled swings. So you can see this is all filled swings right here. We have a swing here, a filled swing right here. So this swing filled to take liquidity from this one. We have also a filled swing right here, right? So we are targeting low resistance. And are we leaving behind high resistance liquidity? Let's look. We have taken this swing right here. So we have high resistance liquidity here. We also have taken liquidity from here. We have also taken liquidity from this. And now you can see that we have clearly the second concept is in fact checked. So on the 15 minute, you can take your entry from here on the order block. You can put your stop loss maybe here above this breaker block. Now to be conservative, you can put it above this breaker block right here, or you can put it here. And now you want to target low resistance liquidity, which is this filled swings right here. You can even hold this trade all the way to that internal range liquidity we have outlined. And let's take a look. Right, guys? And this is not hindsight, and maybe you are telling yourself now that this is hindsight and I am doing this after the fact, and I can assure you that I did all this analysis before, and here's the proof. So you can see I put this trade idea, which is New Zealand dollar against US dollar short. I put on the title liquidity has been cleared, fair value gap has been filled. The next target is this internal range liquidity, and you can clearly see that's exactly what it did, and now it is rejecting. This is the trade that I took. All right. So this is not hindsight, this is my personal approach on analyzing the market. Now let's take a look at another example, right? Now let's take a look at another example, and we have here the Bitcoin against the US dollar chart. This is the 4-hour chart, and this approach works on all time frames, on all asset classes, meaning, and this is Forex, crypto, even the stock market. Now, we took external range liquidity, this swing right here. Now, after taking external range liquidity, our next target should be what? Internal range liquidity, right? Do we have internal range liquidity? Yes, we have this fair value gap right here. Now, after we have a bearish bias on the 4-hour chart, so let's write it here. So the 4-hour is bearish. We have a bias. We have a bearish bias on the 4-hour. The next thing, we go to the 15-minute chart. When you are on the daily, the next optimal chart to look for change in the order flow is the 1-hour chart, right? And then you go to the 15-minute and the 5-minute. When you are on the hourly, when you are on the 4-hour chart, the second optimal chart is the 15-minute. Now, this is not a static rule, but I find this this alignment, this time frames alignment works for me. And this is why I'm sharing this with you. Now we go to the 15-minute and we look for a change in the order flow. So you can see clearly that the order flow is still bullish on the 15 minutes. So we look for a change in the order flow. So we have a market structure shift here. We have broken this swing right here. And this swing represents an intermediate term low. So remember the 12th episode of the 2022 mentorship. So on a buy program, this intermediate term low should not be violated. Also, we have violated this bearish candle right here and this bearish candle right here. On a buy program, down close candles should hold price to go up. Now, after reaching this higher time frame objective, there's no reason for this candles to hold price. And thus we have violated this. Now, what do we have? We have an order block right here. So all these up close candles represent a high probability order block. We took liquidity and then we displaced lower. All right. Now we wait for price to reach this order block right here, and we look for high resistance liquidity to form. So we have a low resistance liquidity to target. We have all these filled swings right here. All right. So we have all these field swings represent liquidity. And now we want to see high resistance liquidity. We have high resistance liquidity here, but let's see what happened. So we are engineering liquidity. We have this sweep, digging even deeper to this order block. We have this swing right here. We have high resistance liquidity forming. Now we look for a 5-minute market structure shift. So we look for a market structure shift on the 5-minute chart. So we do have a market structure shift here. We have taken this intermediate term low, so market advanced market structure, and we left this order block right here. So we have this high probability order block taking the liquidity from here. We have this breaker. We have this fair value gap. So we have 3 PD arrays to enter from. So this is a high probability trade idea. We have all time frames aligned with each other and pointing lower. So now you can enter here and your next target. This is the low hanging fruit, and you can even target all these field swings right here. Now let's see what happens. So price just melt down to the downside, attacking all this low resistance liquidity right here. So you can see that this approach actually works, and with proofs and everything. Now let's take a look at another example, and this is the US dollar against the Canadian dollar. This is the daily chart. So we have external liquidity right here. Now we wait for price. We don't do anything here. We wait for price to either hit internal liquidity or hit external liquidity, and then target this or this, right? So we don't do anything right here. We wait, and now you can see that we have taken external range liquidity. Our next target should be what? Internal range liquidity. Do we have that? Yes, we have. Here we have internal range liquidity here, and we have one here, fair value gaps, right? Now, so the daily bias is bullish, right? Even though we are bearish, but we want to at least see a retracement to this fair value gap. So we write this here. So the daily is bullish. The next time frame is the 1 hour time frame, and we look to the 1 hour time frame, and we look for a market structure shift. So we want the order flow of the 1 hour. You can see it's clearly bearish. We want it to turn bullish, right? To confirm our bullish daily buys. And we don't do anything here. We sit still, and what do we have here, right? We have a market structure shift taking this external range. Oh, this is this taking this swing, right? And we have all these up close candles are a breaker. So we are in fact returning to this breaker, right? We have also returned to this fair value gap. So this is a discount fair value gap, and now we are clearly bullish on the 1 hour. So the order flow is turning bullish. So on the 1 hour, we are in fact bullish. The next time frame is, you can go to the 5-minute or the 15-minute. I don't care. Let's go to the 15-minute and see if we have a bullish market structure shift. All right, so we do have a bullish market structure shift right here, and we have this order block right here. So this is all an order block taking liquidity from here, and while we wait, now we entered into that order block. You can take your entry from here or from this fair value gap. Let's take it from this order block right here. And do we have high resistance liquidity behind us? Yes, we have this high resistance liquidity. We have also this high resistance liquidity. And do we have low resistance liquidity as target? Let's see, we do. We have all these field swings right here. So all this liquidity you can target. For example, here for 4 hour, this is the low hanging fruit. We have this liquidity right here, and you can target whatever you want. So you can see that price exploded to the upside because we have this low resistance liquidity. Now guys, I'm going to give you maybe this week or next week, I'm going to do a whole video explaining how to turn this analysis into a strategy. I'm going to give you the time window, the risk management plan. I'm going to give you everything. I'm going to give you the whole package to use this analysis, this approach of analysis into your day trading. So stay tuned and don't forget to hit that subscribe button and hit like. If you have any questions, please DM me on my Twitter account or leave a comment down below, and I'll answer you as soon as I can. So happy trading and good luck.